In this video, we're going to look at three of Vanguard's ETFs, VAS, VHY, VAP, and we're going to do it by only looking at the facts of each ETF. Just the facts. There'll be no commentary, there'll be no advice, all facts. Let's get into it. So the first thing I always like to do is look at the ETF in the context of the product list for that particular company. So when it comes to Vanguard, they've got 20 odd ETFs, and VAS, VHY, and VAP are sort of in your top 5. So they're quite large in terms of money invested in them within the share market. The other thing is, as a side note, is in terms of the amount of money each of these ETFs actually generate for Vanguard themselves in terms of fees that you and I pay towards Vanguard. And my quick estimate is, and I estimate it by usually looking at what we pay, assuming it goes straight to them, is that VAS is sitting up there around $10 million a year, and then you've got VAP and VHY generating a little around $5-6 million a year. So these ETFs, at least based on my estimates, are doing quite well in terms of generating revenue for Vanguard. Now, when you actually open it up and you look at these ETFs on a side-by-side comparison, this is what you see. The main thing I often see is the market cap sizing on VAS against the other ETFs. It's about 5 times bigger. $10 billion against $2 billion. Not only that, in terms of its size currently, is the next number you see is the amount of money flowing into each of the ETFs. Vanguard's getting somewhere around 10 times more per month. Now, admittedly, I am just looking at February of 2022 funds inflow. And by the way, I get this number from the Australian Stock Exchange's ETP reports. I think it's Exchange Traded Products report. They put it out every month. I'll show you a screenshot. It's available to everyone. It's very free. It's free. You can download it and you can look at each ETF and you can see the amount of funds flow in. And that's where I've gotten that number. And essentially it's showing quite a lot of money is flowing into VAS as an ETF. So it's at this moment, I'll just zoom out again and we'll look at what these three ETFs are actually trying to achieve. VAS is marketed as the broad ETF. Top 300 companies in Australia, banks, miners, CSL, conglomerates, they're all in there. Then VHY is more of an income-focused ETF, which means it's trying to hold companies within it that are more focused on paying out dividends. So you see that in terms of usually you see your miners and the big banks. Then you've got VAP, which is kind of different altogether because it's looking at real estate-focused companies, but not house type of real estate, but more commercial real estate. So shopping malls, commercial buildings, office buildings, where they basically own the property and then they're collecting rent and redistributing that out to the shareholders or the unit holders. And that's where VAP is quite different and it's quite narrow. So if you looked at the three ETFs, VAS has got a broad brush of both income-focused companies and capital growth-oriented companies, or companies that happen to have capital growth. Whereas you've got VHY, which is a lot more on the income-focused side and only has 66 companies in there. And VAP is, again, even more narrow, and it's got like a blend between the two. And I say blend because when I looked at the payout ratios of the top 5 companies between VHY and VAP, there was sort of a mix where you had Accenture, which had an 82% payout ratio on its most recent stats, and the rest were kind of under 50%, meaning they're not paying out a lot of their profits in terms of dividends, they're actually reinvesting it back into the business. Whereas VHY, you can look at all of those companies, they've got quite high payout ratios, so they're paying out quite a lot of their profits to shareholders, which then ends up generating quite good income. Or hang on, I can't say quite good, which ends up generating income for the shareholders. Now let's look at the performance using Vanguard's own stats. So this is full of facts here, only the facts in terms of returns. Vanguard has on their own website a side-by-side comparison tool where you can throw in your ETFs and you can just see what's going on in terms of historical returns. And just a note, the past won't predict the future because it's sort of like driving your car while looking in the rearview mirror. First thing you do see is generally over the longer range, so we're looking in the 10-year mark, VAS and VHY perform broadly the same in terms of total returns. And then you see VAP is sort of sitting a bit off to the side at 12% over the last 10 years. Higher. Facts. That's a factual statement. It's higher. The other thing to point out is the volatility measure that Vanguard did include. We've got VAP sitting at 26% against the 17% for the other two. So it's more volatile in terms of its returns. Facts. sticking to the facts. You can figure out what that means for you. So the other thing I like to do when it comes to returns is look at the composition of the returns, because total returns is usually made up of both capital returns and income or distribution. And when you look at VAS, and this data is available on Vanguard's website, when you look at VAS, it's 60% of its returns are coming from growth and 40% coming from income. So in terms of the distributions or dividends that are paid out. Whereas VHY is on the other side, 60% from income, 40% from growth. Facts. Discuss that with your accountant, what that might mean to you. The word franking credits, income today versus growth tomorrow may come into play. Just discuss that. I'm just pointing it out. That's something you should know. Similarly, when you do look at VAP, it's actually got a lot of its returns from growth as opposed to income. So naturally, my curiosity got me thinking a bit more into how these ETFs performed, purely from a factual point of view, of course. And one thing I noticed is naturally VAS and VHY actually have quite a lot of overlap because the top 300 companies in Australia tend to also have quite a lot of dividend paying elements to them. So when you do look at this, and this is some nice outputs from etftracker.com.au, a handy website based here in Australia, you can look at the VAS and VHY columns and you can see there's an overlap in terms of holdings. But it's interesting that VAP and VAS also have quite a lot of overlap, but VHY and VAP don't have any overlap. And you can actually see that in the VHY documentation where it actually specifically says it excludes REITs, which I thought was interesting. I don't know why they would intentionally exclude REITs from a income-focused ETF, but they did. So my curiosity led me to doing a bit of share price trending using the Yahoo Finance website, just looking at the movements of the actual share prices. So not total returns, just the capital growth elements. And I could see pretty much between 2012 and 2015, this is a 10-year trend, there was pretty much overlap over the two ETFs. Now, obviously, the total returns would have been different because of the income component, but in terms of capital growth, they're broadly the same. Then in 2015, you start to see a bit of delineation where they start to go their own ways. So I know there was a period in 2015 when I know BHP had a bit of a struggle, and it potentially did drag down the VAS and the VHY ETFs with it because it's quite a large holding for those ETFs relative to VAP, which doesn't have your banks and miners in there. So it kind of leads into the conversation around how the ETFs might perform into the future. Now, I'm sticking to facts here, but the key thing I would say is if you're trying to figure out how these ETFs could be used is you really do have to think about the composition. I think that's a good place to start is what's the composition of these ETFs? And what could those companies potentially do over the next few years? I don't know, but I do know there's a clear difference between what VAP has in it and what VAS and VHY have in it, is what I would say. Just think about that difference. That's factual, and I'll leave it there. See you in the next video. Bye for now.